Very good. There we go. Okay. And I'm just going to do a quick introduction. Welcome everybody to this tonight's seminar. This is a presentation that we've done every odd month through the online chapter with the Education Committee. Tonight we're going to be talking about options. Again, we do these every other odd month. So our next presentation would be in January after the holidays. For our speaker tonight, I'd like to introduce Sanjib Saha, who volunteers for several of the nonprofit organizations to help with investor education and financial coaching. He loves to work with others to answer their money questions, writes about various financial topics, and makes investment presentations. Sanjib grew up in India and now lives in the Pacific Northwest. Just as a housekeeping, if you would please mute your microphones, and Sanjib is going to take questions at the end. If there's something in the meantime, we're going to be monitoring the chat through the presentation. Sanjib, thanks.
Thank you, Phil. Hello, everyone. Thanks for joining us this evening. We have a lot of material to cover today, and I hope that you find the information useful. But first thing first, the disclaimers. As always, the session is strictly for educational purpose and not to be taken as investment advice of any sort. It's not a recommendation to buy or sell securities, options, or any financial products. And specifically, option trading involves a lot of risk and the possibility of loss of principal. So please do your due diligence and analysis before making investment decisions. Options and derivatives are fairly complex financial tools. And personally, when I started learning several years ago, the concepts and strategies, they felt like a maze. And there were so many things to learn about options. And today we are just going to scratch the surface. So I'll first cover the underlying concepts behind option contracts, their pricing, characteristics, and things like that. Then I'll walk through 4 basic building blocks of option trading. And these building blocks can then be combined to create more sophisticated trades. And lastly, I'm going to also demonstrate how options can be used to accomplish specific investment objectives that are that can be a little bit tricky to implement otherwise. Now, let me start with a personal story. So one of my middle school friends in India had a Swiss Army knife, and I used to be fascinated that such a small tool could do so many things. So I wanted to have one for myself when I grew up. And years later, I was working in Ireland, and I had to travel to Switzerland for a business trip. And on my way back, I finally bought a Swiss Army knife for myself. So I was very, very thrilled to show off my new toy to my family. Now, unfortunately, I wasn't very careful and ended up injuring myself. And luckily, the cut wasn't very deep. But I learned an important lesson, which is any versatile and powerful tool is useful, but it can also be very dangerous if it is not handled with care. And this same thought came to me when I started learning about options. On one hand, I was really excited to learn about the power and flexibility and so many different things you can do with options. And I experimented with various strategies to make money from my newfound knowledges. But on the other hand, I also came close to burning my hands a few times. And I realized that using it carelessly can cause a lot of damage in a very short time. And I can now understand why Warren Buffett calls derivative products as financial weapons of mass destruction. If you want to use options, my suggestion is to please do it carefully, only after considering how any of the possible outcomes can affect your portfolio so that you can avoid unpleasant surprises. Now, before diving into options, let me touch on a related concept, a forward contract. To explain a forward contract in simple terms, let me introduce two fictitious characters, Tom and Kate. So Tom is a small farmer who grows and sells tomatoes. And Kate has a small business for making and selling tomato ketchups. Now, neither Tom nor Kate has any experience or interest in the retail tomatoes market. And tomato prices, they do fluctuate a lot. And that's a problem for both of them because Tom cannot be sure how much money he is going to make next year from selling his next harvest. And similarly, Kate also doesn't know how to price her ketchup batch for next season because it would depend on how much she would have to pay for tomatoes. So to solve this, Tom and Kate makes a together they make a simple contract, and the contract is very simple. It's next year Tom will deliver 100 pounds of tomatoes to Kate, and she will pay $5 a pound, and no money is exchanged now. So next year Tom delivers 100 pounds of tomatoes to Kate and receives $500. They don't really care about what was the price of tomatoes in the market at that point in time because they decided on the price upfront, price and quantity. So this works out very well because through their mutual contract, they protected themselves from any fluctuation in the tomato prices in the open market. Now, contracts like this are very common in financial and commodities market. And like I said, these are called forward contracts or simply a forward. When they're traded on an exchange, those are called futures. Now, if we dissect this tomato contract, we see that it gives certain rights to both Tom and Kate. So Tom has the right to sell his tomatoes to Kate for $5, even if the market price at that time is less than $5. And similarly, Kate has the right to buy tomatoes from Tom for $5 only, even if the price at that time is higher than that. Now, obviously, Tom and Kate, they both have certain matching obligations too. So Tom has an obligation that his tomatoes are bought at $5 only, even if the market price shoots up to, say, $6. And this obligation of Tom is the counterpart of Kate's right. And similarly, Kate has an obligation that tomatoes will be sold to her at $5 a pound, even if the market price dropped to $4. Now, her obligation matches the right of Tom. Now, because of this symmetry, the contract itself doesn't have any price. All it does, it binds the respective rights and obligations of both the parties and makes the transaction market price neutral. Now, Tom and Kate, they both benefit by eliminating any price uncertainties in the tomatoes market. But there's also a downside. What is that? When the contract matures next year, the actual price of tomatoes in the market can be different than the predetermined contract price of $5. That means one of them will benefit at the expense of the other person's loss. So, for example, if the market price is $6, Tom could have made an extra buck selling them in the market instead of selling to Kate for $5, who is practically paying less than the market price. Or if the market price is lower, then Tom benefits because Kate is paying him $1 more than the market price. Now, what if they want to benefit from favorable market prices while also eliminating the negative effect of price uncertainty? Now, ideally, Tom really wants to sell his tomatoes directly in the open market as long as he can get a minimum acceptable price. And similarly, Kate also wants to buy from the open market as long as she doesn't have to pay over a maximum price that she can afford. In other words, Tom and Kate, they're interested in keeping their respective rights, but they don't want to have any obligations. Now, since this mutual contract is symmetrical and it doesn't really allow that, they now have to turn to the derivatives marketplace. So Tom has to find someone to enter a discretionary sell contract for selling his tomatoes at $5 a pound next year. It's discretionary because he reserves the right to use the contract if and only if tomato prices drop below $5. If he gets better price in the market, he will simply void the contract and sell his stuff directly in the market. So let's say that with some luck, Tom finds an interested derivative trader named Tanya. And Tanya speculates that next year the tomato prices will go up because there's a severe drought coming and that will affect all the produce. So even if she is entering such a one-sided contract with Tom, Tom will not have to use it because he would sell his tomatoes directly in the market instead of enforcing this contract. But what's in it for Tanya? Why would she be interested in taking this one-sided risk? Like she's highly confident that the contract will be voided next year, but she cannot be 100% sure. So for taking this risk, she must be compensated for this obligation. So for that, she demands an upfront non-refundable compensation of $1 per pound from Tom, and Tom agrees to pay. Now, whether Tom uses the contract or not, Tanya will get to keep this upfront payment forever. But with this arrangement, Tom realizes that whatever price he eventually gets for his produce, his net price is going to be $1 less per pound. And this extra dollar per pound is his cost of protecting against an unexpected price drop. So similarly, Kate must find someone to enter a discretionary purchase contract for buying tomatoes for $5 a pound, but she reserves the right to use it if and only if the tomato prices are more than $5. Because if she can buy them cheaper in the retail market, she is going to void this contract. So let's say Kate also finds another interested derivative trader named Kyle, and Kyle speculates that with advanced farming, the produce market next year will be flooded with tomatoes and all other vegetables, and its prices will drop. So just like Tanya, Kyle also demands an upfront non-refundable payment of $1 per pound as a compensation for taking this one-sided risk. And Kate agrees to pay this extra dollar as a cost of, protecting against overpriced market. Now, if we look at what we described so far, there are two separate contracts. One contract is between Tom and Tanya, and the contract gives Tom the right to sell for $5 a pound. And Tanya is obliged to honor Tom's right if Tom wants to exercise that. Similarly, there is a separate contract between Kate and Kyle, and this contract gives Kate the right to buy for $5 a pound. And Kyle is obliged to honor Kate's right. Now let's consider three possible scenarios that can happen next year. So first scenario, there's nothing dramatic that happens in the tomatoes market, and it still sells for $5 a pound. So in this case, Tom and Kate, they basically don't go through the hassle of using the contract because they directly transact in the open market. So they simply void the contract. Tanya and Kyle, they are both free of any obligations. And it turns out that the $1 premium per pound that both Tom and Kate paid, that turned out to be a overhead. Now, scenario two, let's say due to low production or whatever reason, the tomato prices are pushed up to $8 a pound. So that's a good scenario for Tom because he can now sell in the open market and get $8 a pound. And that's a good thing for Tanya also, because Tom voids this contract and Tanya is free of any obligation. And Kate is really happy that she entered this contract with Kyle because she has the right to buy it for $5 a pound. And in the market, it's selling for $8. So Kate actually enforces the contract and asks Kyle to provide the tomatoes for $5 a pound. So Kyle is the loser here because he will probably have to buy it in the open market for $8 and sell to Kate for $5. So he has a loss of $3. But if you account for the premium of $1 that he received, his net loss is $2. Scenario 3, which is tomatoes price drop and they're selling for $2 a pound. So in this case, Tom is very happy because even though the market price is only $2, he is actually able to enforce this contract and sell the tomatoes to Tanya for $5 a pound. So Tanya is the one who is losing because she is getting the stuff for $5 from Tom because she is obliged to honor Tom's right, and she can sell it back only for $2 in the market. So there's a $3 per pound loss. And if we account for the premium that she received, her net loss is $2. And in this scenario, Kate basically, buys tomatoes much cheaper from the market for $2, and she will void this particular contract that she had with Kyle. So these discretionary contracts are nothing but options. These contracts have their own price, and their price derived from the underlying asset, which is tomatoes in this case. Now, Tom's discretionary sale contract with Tanya can be described as Tom bought put options from Tanya, who didn't expect tomato prices to drop. And each contract gave Tom the right, but not the obligation, to sell Tanya 1 pound of tomato next year at the preset price of $5. Similarly, Kate's discretionary purchase contract with Kyle can be described as Kate bought call options from Kyle, who didn't expect the prices to rise. Each contract gave Kate the right, but not the obligation, to buy a pound of tomatoes from Kyle next year at $5. And Tanya and Kyle sold put and call options to Tom and Kate, respectively, and they did so to make small profit while undertaking their one-sided obligations without any right. So to recap, options are basically contracts for trading a specific quantity of an underlying asset. That asset can be a publicly traded stock, an ETF, a future, and so on. A call option gives the option buyer the right to buy the underlying asset from the option seller. And a put option gives the buyer the right to sell the underlying asset to the option seller. The act of actual buying or selling the underlying asset through an option contract is called option exercise. Now, the most important aspect of options is the discretionary nature. The buyer of the option will exercise the option if and only if it's profitable to do so. Otherwise, the buyer will simply void the contract. On the other hand, the seller of the option has no right but an unconditional obligation to the option buyer for honoring the trade if the option is exercised. The strike price of the option is the contract price at which the underlying asset will be traded when the option is exercised. And this is irrespective of the asset's market price at that time of exercise. So if we own a call option, we would exercise it only if the market price of the stock or the underlying asset is above the strike price, because that way we will be paying less than the market price for buying the asset. And similarly, if we own a put option, we'd exercise it to sell the asset only if the asset's current price is less than the strike price, because in that case, selling through the put option will give us a better price than the current price in the market. Now, all options must expire at a predetermined future date. So if we buy an option, we can always sell it back to close our position before it expires. And similarly, if we sell an option, we can buy it back to close our position later before the option expires. And just like stocks and ETFs, options also have unique ticker symbols. So our fictitious tomato option ticker might look like this. So the first part of the ticker is the ticker of the underlying asset. The next part is the expiration date. The third part is whether it's a call or a put. And the fourth part of the ticker symbol is the strike price of the option. Now, options are not free, because if we want to buy an option contract, we must pay the option seller an option premium, which is a non-refundable price to establish this rights and obligation relationship between the buyer and seller. Now, this price of the option that derives from the price of the underlying asset and also the characteristics of the option, which we'll cover a little bit later. And option price, they change dynamically with changes in the changes of the market and the asset price. Now, option premium has two components. It can have an intrinsic value, and it always has a time value. So the intrinsic value is basically the inherent exercise value of the option. To give a simple example, if we have a call option at strike $4, and the underlying stock is trading at $5, we can exercise the call option to buy the stock at $4 and immediately sell it back to the market to make $1 profit. So that $1 is the intrinsic value of that option contract. Now, call option will have an intrinsic value only when the current price of the asset exceeds the strike price. And this type of options are called in the money option. And the intrinsic value is the difference between the strike price and the market price of the underlying asset. Similarly, a put option has an intrinsic value only when the current price of the stock falls below the strike, because we can buy the stock in the open market at a lower price and exercise the put to sell it at a higher price. Now, options that do not have any intrinsic value are called out of the money option. The other component of the option premium is the time value. And time value is the market price of the option buyer's hope that the intrinsic value of the option will rise during the lifetime of the option. So when the option expires, its time value becomes zero. And the payoff from the option at that point is entirely the intrinsic value of the option, if there is any intrinsic value. Now, with that, let's examine the four basic option trades. And the four option trades are buy call, sell call, buy put, and sell put. And sometimes we also use terms like buy call or long call or sell call or short call, buy put, long put, sell put, short put, and all. Now, for an option buyer, the expected payoff is the intrinsic value of the option when it expires. In other words, the option buyer hopes that by the time the option expires, it will have an intrinsic value so that it can be exercised for a profit. Now, options is zero-sum game, which means that the profit of an option buyer comes from an equivalent loss of the option seller. So therefore, from the perspective of an option seller, the best outcome for an option seller is that the option ultimately expires with a zero intrinsic value, so that the seller of the option doesn't incur any loss. So let me demonstrate this for options of a stock with strike price of $50. So the first thing I'm going to show is buying a call of strike price $50. The horizontal axis here shows the stock price, the possible stock price when the option expires. and the vertical axis is the options payoff. Now, because it's a call option, if the stock ends at $50 or less than $50, the option is worthless because no one in their right mind will exercise the option to buy the stock at $50 instead of buying it from the market at a cheaper price. But if the stock ends higher than $50, then the option becomes profitable dollar for dollar. And this is because we can exercise the call option to buy at 50 and then immediately sell it to pocket the difference. And the higher the stock price goes, the higher the payoff from the call option, long call option rise. Now, what about the seller of this call option? As I said before, the call buyer's profit comes from an equivalent loss of the call seller. And this is why the call seller, the short call payoff, the diagram is the mirror opposite of the long call payoff diagram. Which means if the stock is ending at 50 or less than that, then the call seller is off the hook. The contract is voided. But if the stock rises, then the call seller will incur loss dollar for dollar as the stock goes up. And the loss can be unlimited depending on how high the stock actually ends. So the next building block trade is buying a put. And a put gives the right to a put of strike 50 will give the right to sell the stock at $50 per share. Now, this option will expire worthless if the stock ends above $50, because if the market price is more than $50, then you are not going to exercise your put option to get only $50 back. You will simply void the contract and buy it and sell it in the market. But if the price actually drops, then the put becomes valuable because you can still sell the stock at $50, although the market price is less than that. And similarly, the last diagram is for the short put or selling a put. And this is the counterpart of the long put and the mirror opposite of the payoff diagram, which means if you sell a put and the stock price ends below the strike price, then you will incur the loss dollar for dollar, and the loss will be the difference between the final stock price and the strike price. Now, for option trading, it's very helpful to memorize these 4 payoff diagrams because these 4 basic trades, they're like Lego pieces. You can combine multiple trades on the same assets together to create a variety of complex strategies, and sometimes with different strikes, sometimes with different expiration periods, sometimes you can mix call and put options together. And in the next slide, I'm going to examine a specific combination trade like this. And the name of that particular trade is a particular option combination is called vertical spread. So the vertical call spread strategy is basically buying a call option on an underlying asset and simultaneously selling a call of the same expiration date, but with a higher strike price. So to give an example, let's say the underlying asset is SPY, the S&P 500 ETF, and let's say it's trading at $430. And I'm bullish on the market. I anticipate that SPY may get to as high as $530 or more by January 2026. So with this outlook, what I can do is I can buy an at the money call option, that is the call option with strike 430, same as the current market price of SPY. And so for buying that, I have to incur some cost because I have to pay the premium. So to reduce the cost, what I can do is I can sell a call option with a strike of $530. And by selling this call option, I'll get some premium back, although a smaller amount. But my total cost of establishing this particular trade will be less than just buying the call option on. Now, let's fast forward 2 years when the options expire. So if SPY stays flat, this blue line is for the long call at 4:30. So if SPY stays at 4:30, then the option is, or if it ends at less than that, then this call ends worthless. But if it goes up, if SPY is at say 5:30, then this call option is worth $100. If it ends at 6:30, then the call option is worth $200. Now, what about the short call option with strike 5:30? Now, if we recall from the last slide, the short option will again expire worthless if SPY is at 5:30 or less than that. But the short option will lose money dollar for dollar if SPY is higher than 5:30. But keep in mind that I also have a long option which is gaining value dollar for dollar. So that means above 5:30, my loss from this short option will be offset by the gain of my long option. So combining these two options together, the call spread, the payoff is like this. So if SPY ends at 4:30 or below, the payoff is 0. If it goes up to 5:30, the payoff rises and goes all the way till 100. And after that, the payoff basically stays the same. So irrespective of it, whether SPY ends at 6:30 or 7:30, the payoff will still be $100. So let's use this SPY 4:30, 5:30 debit call spread strategy for a hypothetical investment scenario. And let's say I have $50,000 and I have to invest it for a short time horizon of a little over 2 years. And my investment bottom line is no matter what, I must get back my $50,000 principal in January 2026. Now, the cumulative risk-free interest rate over this period is about 11%, given the current short-term interest rate. So I can simply buy a CD, bank CD or treasury for $50,000, and with that, I can pocket $5,500 of risk-free interest over this period. But is there any way I could invest some money in the stock market? Now, the recent market price of SPY is, let's say, $430 a share. I'm a bit hesitant because even though I'm bullish on the market can swing as much as plus or minus 25%, say, over this relatively short period, and I cannot lose any of my principal. So, what are my choices? So one idea would be to put only $45,000 in the bank CD and let the interest of that CD accrue back to the principal. So that way, when the CD matures in 2 years, its value will be $50,000. And remember that my investment objective is don't lose money, which means I must get back my $50,000 in January 2026. So by having buying a CD of $45,000, I still meet my investment goal, but I free up $5,000 today to invest in SPY, invest in the market. Now, even if I lose money in the stock market, I still have my $50,000 to meet my financial goal. Now, if I really wanted to maximize profit from any anticipated market gain, and I'm fine with giving up the opportunity cost of the risk-free interest, I could try a slight variation of this particular strategy. So instead of using the $5,000 to buy the SPY shares outright, I could use it to buy call spread, the same debit call spread that we described before, over 100 SPY shares. So premiums for SPY 430 call options are $70 per share, and the 530 call options are $20 per share. So if I buy one and sell the 531 and establish the spread, the call of the spread per share will be $50. So I can buy 100 such spreads controlling 100 SPY shares. So the maximum payoff of this strategy the second strategy would be $10,000 because that payoff will happen if SPY goes above 530. Now, let's examine how possible market outcomes, some possible market outcomes for both the scenarios next year. So, start with the worst case scenario first, that the market drops 25%. So, if I bought SPY outright, my $5,000 have turned to $3,750. So the cumulative return that I get is 7.5%, which compares with the risk-free return of 11%. So I didn't lose any principal, but there was some opportunity cost that I missed. The second scenario is market stays flat. So my net return will be $5,000 and my cumulative return of the entire money will be 10%. Now, in both these scenarios, I still get something back by using the SPY outright. But what happens with the call spread strategy? In both these situations, the spread actually expires worthless. So my cumulative return essentially is 0%, which means I have my principal of $50,000 thanks to the CD that I bought, but I make no money and I give up the opportunity cost. Now, let's consider the desirable outcome that the market is going up. And if the market is rising 15%, then if we compute the numbers, we see that buying SPY outright will have a cumulative return of 11.5%, but the spread now will give 12.9%. And if the market is, the best case scenario, the market has, gone 25% up or 30% up, the net return from, so in the 25% up case, the net return from the SPY will still be, the cumulative return will be 12.5%. Whereas the cumulative return from the spread will be much higher. So moral of the story is I can make more money with options when things go my way. But when they don't, I risk losing my entire bet. Now, this is a very important aspect of option trading, the implicit leverage that is involved here. So options give higher exposure to the asset for a smaller bet of smaller amount of money. Now, this profit is amplified in the positive scenario, but leverage is a double-edged sword. So in the failed scenario, the loss can be 100%. So this is why we need to be very careful when dealing with options, that oftentimes we run the risk of losing the entire investment that we make in options. Now, if you trade individual stocks, you already know that it's hard enough to make a judgment call about which direction the stock would go relative to similar alternatives. So the same challenge exists for option traders too, because they need to be directionally correct as well. But that's not enough, because to select an optimal strike price, the option trader will have to estimate the extent of the move. That is how far the underlying will rise or fall. And they must also be certain about the timeline by which the move will happen, because all options expire. Unlike stocks, there is no buy and hold story for options. And lastly, the option premium itself, whether it's an exorbitant price or it's a reasonable price, is still another factor. So a good way to get a handle on the complexity is to start with small bets and gain experience through different market conditions. Now, so far, we have focused on option payoffs based on the terminal asset, the ending asset price relative to the strike price. But because options are not free, there is an upfront non-refundable premium involved with while setting up the option trade. This premium must be accounted for to calculate the net payoff from the option trade. So for call options, the premium is added to the strike price to get the break-even price. And for put options, the premium is subtracted from the strike price to arrive at the break-even price. Now, whether the net payoff from the option trade is a profit or loss will depend on the final stock price with respect to the break-even price, not the strike price alone. So I said a lot of words. So let me just try to illustrate with a picture. So let's consider a stock that is trading at $40, and if you buy the stock outright, this is the payoff diagram of our profit. Depending on the ending price of the stock. Now, let's say instead of buying the stock outright, we pay $5 to buy an out-of-the-money call option whose strike price is $50. Now, because we paid $5 upfront, that is we start with a loss of $5. And this is the net payoff diagram. So the call will start gaining value only if the stock ends above $50. But as it goes above $50, first we'll have to recoup the premium that we paid for buying that call option. So the break-even price for us is $55. So if the stock price rises above 55, then we start making money, and if the stock ends at $80, let's say, then our profit will be 80 minus 55, or $25. So we said that options have a premium, like you have to pay some price to buy an option. Now, let's try to get a sense of how option contracts are priced. Now, to be fair, option pricing models are very complex, and I won't dare getting into the weeds. Instead, let me try to give a conceptual sense of option pricing using something called the binomial model. So we'll price a call option with strike 50 for an underlying asset which is trading at $40. And we'll do this for a very small time period, and such a small time period that within that time period, the stock can end only in one of the two states. It can either go up and end at $70, or it can go down and end at $20. Now, if we look at a call option at strike price 50, this call option when the stock ends at $70, the value of the call option is $20, because $70 minus the strike price. And if the stock ends at $20, because the call option is at strike 50, the value of the call option is $0. Now, given these two payoffs, that these are the two possible outcomes, the call option will either be $20 or $0. What is the price of this call option before this period? So to price the call, we can create something called a replication portfolio. And we can create a replication portfolio using the stock and risk-free bond, such that in each of the possible two outcomes, the value of this replicating portfolio is the same as the payoff from the call option. So we create a portfolio with $B of risk-free bond and delta shares of stock, such that the portfolio value at expiration is identical to the call value in both the scenarios. So let's start with the upward outcome when the stock ends at $70. Now, we already know that the call at this point is worth $20. Now, what is the value of this portfolio when the stock ends at $70? It's B plus delta times the price of the stock, which is 70. So if we say that the value of this replication portfolio is the same as the value of the call option, that gives us one equation, which is B plus delta times 70 is equal to 20. Now let's do the same for the second scenario. That is the down state when the stock ends at $20 and the call is worthless. So the combined value of the replication portfolio is B plus delta times 20, which is the current price of the stock, which is equal to the value of the call in this particular scenario, which is 0. If we solve this two equation, we get B as -8 and delta as 0.40. In other words, to replicate this call option, we must borrow $8 at risk-free interest rate and simultaneously buy 0.4 shares of the stock. Now, since this value of this portfolio is the same as the call option value in each of the ending state, that means the initial price of the call option is the same as the price to set up this replication portfolio. So this is the binomial pricing model of the options. And per this model, the price of this call should be $8. Now, remember, we price the call option over a very short time period where the stock can have only two possible end values, one up and one down. But the beauty of this model is it can be extended to price the options over successive periods. So many such small successive periods will constitute a long enough period, and through that, this model can be extended to price options over any duration, where the stock can end at many possible values. So in the interest of the time, we'll skip the details, but from this analysis, let's examine some of the important factors that affect the price of an option. So the most obvious factor that affects the options price is the strike price. Because if you remember the previous example, if the stock ended at $70, the call with strike 50 will have a higher payoff compared to a call with strike 60. So naturally, the price of the 50 strike call will be higher than the price of strike 60 call. And therefore, the price of the option will also go high. And this is the graph that illustrates the relationship of a call option price in terms of the possible strike price of the particular option contract. The red portion is the intrinsic value of the call, which exists only when the call is in the money, and the green part of the price is the time value of the call. The time value is highest when the strike price is closer to the current price of the underlying asset, and the time value will taper down as the strike moves away from the current price. The second factor that determines the price of the option is the time left on the option. More time left means that the underlying stock would likely end higher or lower compared to a smaller time period, which means if the stock is ending higher, that means the payoff of the option will also be higher, which means the price of the option will, for longer expiration, should be higher than the price of the option with smaller expiration. And this particular graph shows the relationship that there is as the expiration shortens, there's a decay in the time value. And this time value decay is an important aspect of options. Because what this says is if you buy an option and everything remains the same for days, the option will simply lose value slowly. And on the flip side, if we sell an option and nothing changed for days, the price of the option will reduce, which means we'll be able to buy it back for a smaller premium and make some profit. Now, the third important factor affecting the option price is the volatility of the underlying stock. And this is also very intuitive because the more volatile a stock is, the more extreme its range of outcomes would be. And that means the option payoff will rise with more extreme outcomes. And hence the price of the option will also rise, as has been illustrated in this particular graph. So one takeaway from this is when the market is calm, the volatility is low, option buying may be a cheaper strategy. And conversely, when the volatility is very high, the option prices are inflated because of the higher volatility. Selling option may be a more profitable strategy. So let me digress a bit. We talked a lot about theoretical stuff. So recently I was chatting with a friend the other day, and he told me a recent stock market gamble that he made with a tech company. So long story short, apparently he used to work in this company and he owned company stocks. And he had such a high opinion about that company that he bought additional shares of the company even after switching jobs. And that stock did exceptionally well a few years ago, and he sold most of his stocks and made some money. But he regretted big time cashing out because apparently the stock tripled over a couple of years, from his selling price. And it so happened that the stock again sold off in 2022, and he couldn't help getting back in. So he basically went, put a lot of money in that stock when it sold off, and that bet worked out very well for him because he was able to cash out again for a big gain in a very short time. Now, he agreed that he took a huge risk based on personal conviction, not so much of research, and he simply got lucky with his gamble. He just wanted to gamble with someone. Now, with this story, I couldn't help wondering how his speculative conviction would have worked using call options, because these call options are typically great for asymmetric risk reward situation. So, for example, if you want to gamble with a stock that has a slight chance of a huge price breakout in the near future, a deep out of the money call option gives a lot of leverage with limited loss potential. So I decided to look up the charts for that particular stock he was talking about. The company is NVIDIA, which has an interesting price movement in recent years. For those who are familiar with the NVIDIA price movement, between 2020 and 2021, the stock rose almost 7 times. But then it came crashing down in 2022, lost almost 70% from the peak. And this year, the market has again sent the stock to the moon. Now, this is the price. Let's compare the price changes for NVIDIA stock versus the price change of an NVIDIA January 2024 call option at strike price 500. The blue line is the stock price of NVIDIA, and the left axis is the NVIDIA market price. And the red-green line is the price of the call option, and the right-hand axis is the corresponds to the price of the call option. So if we look at it closely, so from bottom to in 2022, from from bottom to top, NVIDIA rose almost 3.5 times, from its bottom. So my friend probably, bought it back sometime here and sold it, somewhere here and made some, probably doubled his money or whatever. Now look at how much the call has changed. The call has increased more than 200% from its bottom to the top. So this explains the huge amount of leverage that call options give with a small bet, a speculative bet like this. And this is the kind of asymmetric risk reward that will often attract, some Robinhood traders who will chase meme stocks through options, and they just hope to make a quick buck. And this is the reason that it attracts those traders. Now, from call, let's turn our focus to buying puts. And to recap, put option gives the holder the right, but not any obligation to sell the underlying at the strike price. So someone bearish on a stock and expecting a substantial drop might buy a put. So here's a quick recap of the payoff. So let's say the stock is trading at $40 and we are considering an out of the money put option at $30 strike, and the put option cost $5. So our break-even price will be $25. And if we own the put option alone, then the put option will gain value if the stock ends more. But if we own the stock and also buy a put option called a protective put, then this will be the combined payoff of the overall position. So basically, by doing this, what we have done is we have basically placed a ceiling, placed a floor of the stock price by buying a put. Why? Because we own the stock and we own the put. So if the stock price drops below the break even, our we lose on the stock, but we gain on the put side, and they offset each other. So our combined value stays the same because the loss is offset by the options gain. Now, this may sound very attractive, but downside protection through put option, it can be very, very expensive. And this chart will show how it drags the portfolio performance. So here are some of the prices that I picked recently. I think it was in October or late September, when Microsoft stock was trading at around $330. And these blue columns show and the left axis show the price of a put option with strike 330 for various expiration periods. And this red line shows how much annualized performance drag, it causes if we own a put option to protect our position in the particular stock. Now, for short expiration, the cost is not that bad. I have occasionally used short-term puts in a particular scenario only. So in my case, my company grants stocks every year and they vest over a period of time. So I was expecting a large amount of waste in, I think, next 3 months or 6 months or something like that. I forgot the exact details. And it so happened the stock was hitting a new highs. And I wanted to lock in my gain. But I didn't have the shares vested yet because it would vest 6 months down the road. So what I did was I bought a put option, whose expiration date was close to that particular vesting date. And this is just to lock in my profit one time. I've done this a few times, but I didn't actually have to use the put anytime. So in all cases, those were overhead, but this is one use that I um, took advantage of. Now, buying an option seems less risky because the maximum loss is limited to the upfront premium that we pay for buying the option. Plus, there is a small probability of a large profit. But when I talk about selling options, it always reminds me of this picture. This picking up pennies in front of a steamroller. The profit can be usually very small, and the probability of making that small profit tends to be reasonably high. But the probability of loss is, which means the probability of loss is low, but the probability is not zero. And typically with selling options, the losses are huge, or in case of call options, the loss can be unlimited. So whenever we are dealing with selling options, we need to be very careful what will happen if the trade ends against us. What is the extent of loss that happens to us? Now, talking about selling options, let me discuss a popular option strategy called covered call or buy right. So this involves selling an out of the money call for a stock that we already own. And we might consider this strategy if we are slightly bearish on a stock or at least not overly bullish. Let's say the stock is trading at $40 today and we sell a call option at strike 50 and we get a premium of $5. So here's the net payoff diagram for the call option at the expiration. Now, the green arrow shows the profit coming from the profit or loss due to the stock price movement, due to owning the stock, and this shows the loss for selling the call. So if we combine these two, this is the payoff of the covered call strategy. So basically, we are boosting our return little bit by the premium, but we are also capping the upside potential of the stock, because if the stock breaks out, our gain from the holding will be offset from the call that we sold, or basically it will be, the profit will be capped. Now, there is some evidence that out of money covered call strategy boosts risk adjusted return in some market conditions, especially for low volatility stocks. But personally, I'm not a very big fan of the covered call strategy myself, especially for core holdings, because it limits the upside of the core holding if there is a huge price breakout. Now, writing covered call can also be a good strategy to sell stocks that we own if we are not in a hurry to sell it and we are not really worried about the downside of owning the stock. So let me give a small example. Again, I'll use Microsoft stock. Let's say we have bought the stock at $130, and the current price is $330. So we want to sell this. We want because the stock has gone up a lot, but selling this also incurs a tax liability. So that gives us a little bit of pause. So if there was no tax involved, we would have sold it today. Now we can do a little bit of behavior hack with a covered call strategy. We can sell an out of money call option and offset. So by doing that, we'll get some premium. And if the call is exercised, that means the stock is called away, there will be some additional gain also above 330. So together, this may actually take care of the tax liability portion. So here are some samples of the MSFT call options for different expiration periods and different strikes. We choose any of them, and if that option eventually gets exercised, the extra profit that we have, if it gets assigned, that will take care of the tax liability. And if the call exercise, the option expires worthless, then we keep the premium and rinse and repeat. Write another call option on this. Now, we talked about downside protection using buying put. Now, what if we want to have some downside protection without paying upfront for the premium? Thankfully, there is a strategy called collar, through which we can pay for the downside protection by selling some upside of the stock. So let's say the stock that we own is trading at $40 today. And we can deal with a 25% price drop, but we'll freak out if it drops further. So we want to, sorry, buy a put at strike 30 to protect us from a drop beyond 25%. Now, this put costs $5. And to buy this, to fund this purchase of the put, what we can do is we can also sell a call on this particular stock, because we own the stock. We can basically create a covered call on this, such that the premium from that call funds the purchase of the put. So basically, we have two options. We buy one put, the blue line, and we sell one call, the red line. And the put is at $30, and the call is strike at $50, and the premium of both are the same. So that means we are setting up this collar position without having to pay any upfront cost. Now, what will be the behavior of the combined position? If the stock drops below 30, then the put will protect us. So that means we have put a floor on our holding. And on the flip side, if the stock breaks out and goes above 50, then the gain from the stock is going to be offset by the loss from the short call. So this purple line shows the combined strategy. So we want to protect a stock that we own. We want to keep a downside, have a downside protection. And instead of paying cash to buy the put, we give up some upside. So this can be a handy strategy in situations where, sorry, we do not want to, for some reason, we cannot really sell the stock or we have to hold on to the stock. The last building block option trade is selling or writing put, and which means signing up for the obligation that we may need to buy the stock if the price falls. So this may be a good strategy if we are generally bullish on a stock, or at least we don't believe that the stock would drop beyond a certain point. But if the stock actually drops, then we might have a substantial loss depending on how far it drops. And this is the payoff diagram that we have seen before. And if we account for the premium that we receive from the put, that actually makes our break-even price, reduces the break-even price. So that means if we sell a put um, uh, uh, at $30 strike put and get a $5 premium, then we are okay until the stock drops beyond $25, in which case we'll have to buy it for the $30 strike price that we had. Now, selling put can be a good strategy to buy stock at a lower price, as long as we have the money ready to buy the stock if it is exercised. So here's a hypothetical situation. And let's say I want to buy QQQ. QQQ is the NASDAQ 100 ETF. And it was recently selling for, I think, $365. And I would have bought it if the price was $300 that day. Now, I could place a limit order or a conditional order or something like that for QQQ, so that if the price drops at or below 300, then I buy it. But an alternative would be to sell a put option at strike $300. Why? Because we'll get some premium upfront, and if the price falls below that strike and the put is exercised, I'll get the stock at my acceptable price. The premium and the lower purchase price will essentially create a margin of safety compared to the current price. And if the put expires worthless, I'll simply keep the premium as a reward for my patience and perhaps sell another put. Now, this may also sound like picking up pennies from steamroller, but remember, the worst that can happen here is I end up buying a stock that I'm fine owning at my acceptable price. So this strategy is called cash covered put. And here is the chart for based on the recent prices of put options at various expiration. So the current price of QQQ at that time was 365, and I was looking at QQQ put for strike $300. And the blue line is the annualized yield that you get from the premium. And this is on top of the interest that you are getting of your cash reserve. And if it gets assigned, the red line actually represents how much margin of safety we are getting by purchasing the stock using the put option. So as you can see that compared to the market price, using this strategy, you can get more than 20% of discount or margin of safety, depending on what expiration period you choose. Now, this ends our presentation today. Sorry, I think I went way over time. Just to recap, options are very versatile, but unless we are very careful, they can also cause substantial unlimited loss. I have put some link for a few handy resources. And with that, I hope the presentation was useful, and thank you again. And feel free to reach out to me for any questions.
Thanks very much, Sanjib. At this point, we can open it up if anybody's got any questions. I know, given the time, we're at about 9:40, but is there any questions at this point?
Please unmute yourself and ask the question.
Impression I get is that a lot of us are newbies with a little bit of information and or trading experience with this. So it's a lot of information to take in and get enough confidence to try the first trade. Some alternatives that I've run across, depending on the broker, they offer some brokers will offer a paper trading option where you can actually try something without actually putting actual money in and see how it goes. Kind of try a strategy on something and see how it makes out before you ever actually invest, either buy or sell an option. So that's another strategy that you can that I ran across that you could try without actually putting any money at risk.
Yeah, that's a great suggestion. And also, for starting with small bits, it may be better to try the buying option strategy, like anything that involves buying, because the loss is kind of limited. The premium that you pay to establish that buying buying trade is the maximum loss that you can have.
Was a question with regards to the handouts or copy of the presentation. And what we normally do with these, with a recording, we'll put the slides up on the website in a few days. So you can look for the presentation and replay that as well as the handouts at that point. Not having any other questions. I don't know if this is a quick question or not, but one of the concepts that I've run across, Sanjib, I don't know if you've heard or seen anything with regards to something called a wheel strategy with options. Have you heard or used that before?
Will?
A wheel. So basically the simplified concept is that you the way I heard this is you don't have to put any money out as in buying, but it's more of a sell strategy. So if it's like you said, if it's a stock if you're interested in and you wouldn't mind owning at a certain price, you sell a put on it, and worst case is you get the stock put to you at a certain price. So you own the stock. Then you turn around and sell a covered call on it.
Right.
And then
and
then you kind of it's called a wheel, and you basically circle the strategy, so you're not really putting any money out, and at the worst case you're owning a stock you wouldn't mind owning anyway.
Right. Yeah. I have heard that one. The term I heard was sell, put, then call, or something like that. So in the Fidelity investor community, there was one participant who basically introduced this particular strategy to the other community members, and I remember he reported some of his trades also.
Okay.
Yeah, that sounds like a very reasonable thing to do.
I just kind of like the concept of it because you're not actually putting any money, out. You're not paying option premiums.
Right.
But obviously it depends on where things go. Yeah.
Right.
And then I don't know, potentially you could make an argument the best case is in that scenario where you're selling options is that if you run out of time frame and they expire worthless, you're actually gaining from that
Okay.
possibility as well.
Yeah. Yeah. Yeah.
So I think we've flooded everybody with so much information, people's heads are turned.
I'm sorry.
No, that's good. I think, like I said, I
Yeah.
think we've got a good amount of interest. And again, it's kind of one of those things it's kind of one of these things you kind of it's best to wade in slow and get your feet wet a little bit.
Yes. It's not a straightforward process. You need to think through and you need to execute it properly.
Right.
And again, I think it goes back to, all of us, the first time we invested, we were a little apprehensive as well. And to date, whether you've been investing, a month or 10 years or 30 years, whatever, you get more experience as you go. The thing with the options, as I was explaining before we started the presentation, is in my perspective, it kind of seems like, with normal investing, the object is to buy low and sell high for gains, right? But with
Yeah.
options, you kind of turn everything inside out, and
Right.
you kind of gotta think about things a little bit differently because it's a different method or strategy to invest.
Okay. So one other benefit that I saw with just knowing about the internals of options is, so recently there are a lot of new investment products like buffered ETF and structured notes. So basically buffered ETF is you will have certain you will not lose your principal beyond a certain limit, and you will participate in some percentage of market upside and things like that. And typically they come with very high fees, and people actually those products are attractive to people. Now if you and they're very simple to, they're actually implemented using options, and they're very simple to implement it. So if you really want to, if someone really wants to modify their portfolio like that, instead of buying this expensive products, they can just implement it straightforward in using just regular options.
All right. Last call. Any last minute questions? Okay. All right. Well, I'm going to say thank you for everybody coming to the seminar tonight. Thank you, Sanjib, for doing the presentation. I think it's a lot of great information, and the examples were greatly appreciated.
Thank you for the
Thank you very
opportunity.
much.
All right. Everybody have a great night and a happy Thanksgiving.